Hi, I'm Jeff Colton. In this unit, I'll give you an overview of the financial reporting landscape so that you will better understand the context of the information you will be analysing over the term, which in turn should help make you better communicators and better decision makers. We'll consider what is required in financial reporting, who makes the rules, who enforces the rules, and what are the basic set of financial statements. We're thinking this week primarily about financial accounting. Remember, that's the set of information that a firm provides to outsiders. In the second half of the course, we look at management accounting, which focuses on information used for internal decision making. Things like costing, budgeting, and capital allocation decisions. First, what is accounting? You've probably heard accounting described as the language of business. Taking that in slightly more detail, we can say that accounting is a system for recording information about business transactions to provide summary statements of a company's financial position and performance to users who require such information. Let's think about that. First, transactions. What events get recorded? It turns out that not everything that a company does makes it into the financial statements. Knowing what is and is not recorded in the financial statements helps you determine how effectively those statements can provide useful information about an organization's economic performance or information about its economic or financial position. To summarize, imagine if you were given an annual transaction list for BHP or Woolworths. An immense amount of things have happened over the year. You would want some way of classifying and summarizing them. That's what the financial statements do. Third, and the final part is users. Financial statements are meant to provide useful information to a wide range of users and help people with a range of decisions related to an organization. It helps shareholders and potential shareholders decide whether to buy, sell, or hold shares of companies. It helps banks and other lenders decide whether or not to lend to a company. It helps managers run enterprises on behalf of owners. It provides basic financial records for the purposes of day-to-day management, control, insurance, and fraud prevention, and is used by governments in monitoring the actions of an organisation or enterprise and in assessing taxes, and helps customers make decisions around purchasing, including assessing the likelihood that a business will be around to honour a warranty. Financial accounting information is useful for public sector organisations as well as private sector firms. For example, information is needed to make judgments about whether or not a department or other reporting entity is achieving its objectives, whether a department is operating economically and efficiently in achieving its objectives, whether or not resources have been used for the purposes intended, and whether continued support for a department's activities is warranted in the future, and if so, the quantity, quality, and price of resources necessary to support those activities, and whether a department has the ability to continue to provide goods and services in the future, and if so, the quantity, quality, of price of the goods and services to be provided. So what are the main financial statements? First, the balance sheet. It shows the financial position at a point in time. It's a snapshot of the resources of an organisation and the obligations that the organisation has and how those resources have been funded. The funding is either by debt or equity. A balance sheet normally includes the financial position at the end of 2 consecutive financial periods. So the balance sheet for 30th of June 2021 will also show figures for June 2020. This allows users to see which accounts have changed over the course of the financial period. The income statement measures performance over a period of time by matching revenue earned with expenses incurred. It's also known as the profit and loss statement or the statement of financial performance. The statement of cash flows shows the sources and uses of cash during the period. The cash flow statement is divided up into 3 sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. We'll cover each of these statements in more detail in the next 2 weeks. The financial reporting rules for our large public companies and other organisations are based on what we call accrual accounting. This differs from cash accounting, which simply records when cash comes into the business and goes out of the business. Under the accrual accounting system, the key test for revenue recognition is whether the goods and services have been rendered, that is, delivery made to a customer or the provision of a service has been made. The receipt of cash is not required for revenue to be recognised. Let's see how this works in practice. Take Qantas, Australia's largest airline. Qantas makes most of its money by flying passengers. If you think about how you buy a plane ticket, you typically have to pay the money well before your flight. Under accrual accounting, Qantas is not able to recognise revenue when we pay for the ticket in advance. They can only recognise the revenue when they actually fly the passenger. Revenue from things like passenger services fees is also recognised when the services are provided, not when the cash is received. Another example is BHP Billiton. BHP is one of the world's largest mining operators. Sale of products is recognised by BHP when the risks and rewards of ownership of the goods have passed to the buyer based on agreed delivery terms and can be measured reliably. Depending on customer terms, this can be based on issuance of a bill of lading or when delivery is completed as per the agreement with BHP's customers. Again, revenue is not always recognised at the same time as cash is received by BHP. Much of the production of large commodity producers like BHP is tied up in long-term contracts with end users. These contracts usually specify when various performance obligations of the seller, such as BHP, such as extraction of the coal from the ground or delivery of commodities to a port. BHP is entitled to recognise revenue as it completes its performance obligations under the contract. It does this by separately allocating the contract price to the separate performance obligations. Similarly, under accrual accounting, expenses are recognised in the period in which they are incurred, not necessarily the period in which cash leaves the organisation. For example, if your firm pays for TV advertising in May, but the ad does not air until June, the advertising expense is not recognised in the financial statements until June. We'll go through accrual accounting in more detail in Unit 3 of the course. So where do the accounting rules come from? In Australia, the Corporations Act sets out what companies and other organisations need to provide. The Corporations Act says that organisations need to prepare financial reports and other information. The Act says that these financial reports need to comply with the relevant accounting standards. The Act also says that the Australian Accounting Standards Board, the AASB, is authorised to make accounting standards. Australia, like a lot of countries, has chosen to adopt international financial reporting standards. So the AASB is involved in helping prepare those. The accounting rules typically require organisations to provide additional information with the financial statements. These include the notes to the financial statements, which provide details on specific items found in the main financial statements. For example, firms are required to disclose information about their different operating segments so that users of the financial statements are in a better position to evaluate how different parts of a business are performing. BHP discloses results by petroleum, copper, iron ore, and coal. Qantas reports information for the following segments: domestic, Qantas International, Jetstar, Qantas Loyalty, which is the frequent flyer program, and corporate. Other disclosures include information about executive pay, as well as a general discussion of results, which is typically found in the management discussion and analysis section of the annual report. Some disclosures are required by the relevant corporations legislation, and others are required by stock exchange listing. In Australia, the stock exchange requires that listed firms immediately disclose to the market any information that would likely affect the share price. This is part of what is known as the continuous disclosure regime. Information that companies must provide is called mandatory disclosure. Of course, organisations can choose to provide more information than the minimum required. Any additional would typically be called voluntary disclosure. For example, increasingly firms have been disclosing alternative measures of performance to those required by the accounting rules. These are known as non-GAAP or pro forma measures. GAAP is generally accepted accounting principles or the accounting rules. Firms are often willing to provide this additional information. If investors do not have the same information as management, they will probably find it difficult to value new and innovative investments. If investors are uncertain about the future prospects of a firm, it is rational for them to take a conservative view, which would lead to a firm being undervalued. In addition, firms will often provide additional disclosures to compensate for the limitation in mandatory accounting rules. Many managers believe that the accounting rules do not allow them to do a good job of communicating the underlying economic performance of their business. Managers often include an articulation of the company's long-term strategy, specification of non-financial leading indicators that are useful in judging the effectiveness of the strategy implementation, and forecasts of future performance. One constraint on expanded disclosure is the competitive dynamic in product markets. Disclosure of proprietary information on strategies and their expected economic consequences may hurt the firm's competitive position. Managers then face a trade-off between providing information that is useful to investors in assessing the firm's economic performance and withholding information to maximize the firm's product market advantage. Okay, I think that's about long enough for today. So I've given you a broad summary of the financial reporting environment. We've shown you what the financial accounting is, what the main financial statements are, and introduced the idea of cash versus accrual accounting. We also covered the institutional landscape and where the accounting rules come from. The best way to try and think about all this is to start looking at financial statements. And the best statements to start looking at are for businesses that you have the most familiarity with. So grab your own firm's annual report or an organization you'd like to work for. Just go to the main financial statements and see what's there. We'll be exploring exactly that in the next few weeks.